Hi, thanks so much for joining in. You're watching BQ Prime. My name is Alex Matthew. It's been a topsy-turvy couple of weeks for the equity markets here in India and indeed for equity markets globally because there are a lot of moving parts at play. And of course, this is a very relative statement because when is it not volatile, right? But it's sometimes more volatile than at other times. But to make sense of all of the factors at play, I'm joined by a veteran in the markets, market expert, Ajay Bagga. Ajay, thanks so much as always for taking the time and for speaking to BQ Prime. Now, I will ask, do you think, as you look at the scenario right now, not just here in India, but when you zoom out and look at the rest of the world as well, are there more moving parts now than there have been in the last couple of years?
No, I don't think so. It's just that with the media coverage, we get to see a lot more. And then overnight, we become experts. I don't think anyone in India 2 years back even knew broadly where Ukraine was. Unless you had a child studying there, you just kind of knew that, okay, in Central Europe somewhere, or if you went for a badminton tournament, your child was playing there. That was about it. We all became experts in Russia, in Ukraine, in NATO, and now to the entire history of Israel and Palestine and Hamas and Hezbollah. So it's more overdone. Most of the risk that you imagine in the markets don't come through. Of course, there is an outlier risk and markets do tend to price that. And that is the big risk of the Middle East conflagration expanding. Now, if that happens, we will tackle it at that time. You can't keep changing your asset allocation based on that. So I think it's overdone. The broad theme we have to see, are the interest rates nearer to peak or are they nearer to a trough? I think they are very much near to the peak. Is it December 13th or is it by February that the Fed says we are more or less done? Maybe they won't say it till February. Maybe they'll stay data dependent because this is a different central bank from, say, the time of an Alan Greenspan, over economists who used to pride themselves on forecasts. Moment you say data dependence, that means your forecasts have not worked and you don't want to make any more forecasts. So that makes it a tough market, but it's not a non-investable market. And again, if you focus back on India, you see a much better story. But I think that globally, the geopolitical risk has got enhanced because of a belligerent China, a belligerent Russia, and what's happening in the Middle East. But, those are probabilities and they have always been there.
How big of a risk is a higher interest rate for longer scenario globally from the perspective of Indian external borrowing? Is that a major risk?
It's not, because the RBI is very conservative. And if you look at our FX reserves, they kind of balance out our outstanding. So RBI is very careful on that. And if you add on the remittances that we get and the invisibles, what we call the software exports, and now another burgeoning sector is the services exports, which is really taking off. If you add all that up, we are not in any kind of a worrisome situation. Yes, oil price, yes, interest rates going up have an impact. And if you remember 2022, September, October, 65 out of 65 economists on Bloomberg were saying that there's a recession in the first half and second half will be better. We did the reverse of that. We had very good first half and now we are shaky going into the second half. And again, there are the calls of a softish US. But, always remember, the economy going down will mean the rates would have been toppish. And as rates see a plateau and start coming down slowly, the markets will just rush up. So prepare for that. It might be 3 months, it might be 6 months, it might be a year. I can't time it.
No one can.
But on a macro top down, if you ask me, we are in a better situation than we were this time of last year. Last year, you were still raising rates. We had 285 increases in interest rates all over the world in 2022. Now we are done with that.
Yeah, more or less.
ECB didn't raise.
Yeah.
UK has more or less stalled. Australia, maybe one more. Japan today said that yield curve control will slowly get out of, but it was wishy-washy.
Yeah.
It wasn't like
no
a very
clear statement.
no clear statement. And That was the old central banks who wanted to be non-transparent. New central banks are either data dependent or very transparent. They keep transmitting. So difficult for the markets to gauge. But again, I'm saying, think February, think May, think that your topish rates, and when there is the market sees that in 6 months, maybe one rate cut is coming, they will just run.
What about individual balance sheets, Ajay, in terms of companies that have looked abroad for external commercial borrowing over the past several years, refinance risks? There are a couple of companies with significant leverage. Is there a concern for them?
Those are priced in largely. There are promoters in trouble, promoters who have huge amounts of their own equity pledged already, plus this. And unless you have a natural hedge where you have export earnings to have taken ECB, yes, there are a few companies, but an economy-wide or a corporate India-wide, if you look at 2012 and 2023, we have solved the twin balance sheet problem. Banks don't have NPS. Banks have 1%, 2% NPS. Their provision coverages are 65 to 80 kind of percentage. So you don't have a bank balance sheet issue. You don't have a corporate balance sheet issue. You've not had private capex yet returning because 2003 to 12 was such a huge that we built over capacity economy wide. That will catch up. 2024, 25, post the election clarity, you will see that following through. Government capex is doing well. So short answer, few companies will be in trouble. They will have to look at, finding ways, either selling out equity or refinancing. Refinancing is not easy at these rates. So there will be trouble for a few companies, but broad brush corporate India, not an issue.
I want to turn to valuations and opportunities in India, and I want to set the context by providing a little bit of data. I asked Morningstar to give me some information on the cash that is being held by equity mutual funds. And as of September, and we will get data for October only in about 15 days or so, but as of September, it was around 90,000 crore rupees. Now, I looked at the FIDISL number, and by and large, it's mutual funds that are selling or buying, and that's over 20,000 crore rupees. So, assuming that you have certain amount of money coming in through lump sum as well, we're still thinking around 80 to 90,000 crore of dry powder, if you can call it that. And as a percentage, Ajay, of the whole, it's about 5%, which is relatively elevated. Does that tell you that opportunities to buy are limited in this market? Valuations are stretched on the broader end of the spectrum, particularly.
See, valuations are reasonable, I would say. Again, the fund managers look at, now they moved to FY 2025.
Yes.
Because 24 is another 6 months or 5 months now to end. So you price in, say, 1,100 rupees on the Nifty, you're looking at 16, 17 times. So it's a very reasonable market. It's not overpriced market. Pockets are there which are reasonably overpriced. Sectors that really ran up, be it defense, be it railways, EMS, all the stories that were cooked are not so reasonably priced. FMCG in India always is very expensive. That stays. So I would say the 90,000 crores is not a timing done by the fund managers. They 2 to 5% is par for the course because you're providing daily liquidity. Sure. I would love to be a fund manager with a locked up fund like a hedge fund and opening windows, opening gates once in 3 months, 6 months. We don't have that privilege. So they have to keep liquidity for any unforeseen event, and they try to catch up on that by using the amount of derivatives that are allowed, and you try to get your participation up because people will see your performance against the index. They will not see that you were investing 95%.
Yeah.
So I would say this is not inordinately high. And if you look at the global fund manager surveys, those are at 3.9 to 5% kind of cash holdings. Does that provide an opportunity? Yes, I think if there is a dip, this money will get allocated quite soon. The good thing is the SIP number. And, really, if you see from the COVID March 2020 to now, who really made the serious money were the SIPs, because the HNI money went out in April and kept waiting for the second dip, kept waiting, and that never came. And then we've got flattish markets from about September 2021. We were 17,500, and you made 4-5% returns in 2 years. Not very great. So that HNI money has been very, inconsistent and waiting. Second big thing is you started making good money on the fixed income. If a GSEC is giving you 7.38, 7.4, and a good, well-run mutual fund, very conservative public sector is giving you 8%, HNI money went into that rather than coming back into equity. But the SIP guys kept investing. And that 15,000 crores will go up. Your EPFO will come. Your insurance will come. Mutual fund lump sum, I don't know. It's been largely a negative, and the SIP has been taking care of that. But as you said, there is dry powder of 90,000 crores sitting. So it's made it a very resilient market. October, you lost 22,000 crores to FI outflow. After January, we have seen the biggest. Market would have been down 5-6% at least. We're down 2.5% because of your domestic flow. So the characteristic of the market is changing. This FI flow will come back. Again, as the rates go down in the US, very strong correlation. See, strong dollar, negative correlation to EM flows. So we went to 114, came down to 100, again started going to 106. Now it is toppish. As the rates plateau and look to go down, dollar will weaken, your EM flows will catch up again. India will see the flows, part of that. Second big thing, interest rates cycle, as it tops, EM flows will start again. So those two trends again are working for a better 2024. Flows wise for India. Political risk will be heightened with the national election, and now with the state elections. So 3rd December, 30th November, you will have exit polls, some amount of volatility. 3rd December results will come. People will extrapolate it like in 2019, and some amount of shock will be there in the system. And then May is the election. So FI flows, the non-sovereign, non-pension fund, which is a 5-year money, might be constricted. But again, what we are telling FIs, whoever we meet, I have a big delegation coming from Norway over Thursday, Friday, and they're meeting a lot of Indian investors. I'm also addressing them. What we are projecting is 5, 10, 15-year India. So if you're 2040 India in mind, and you're 14-15 trillion dollar economy, you're a 14-15 trillion market at the least. So you're looking at 4 to 5 times return just on just the market,
on a conservative.
And if you get alpha on it, if you can go down the cap chain, get some good fund managers to manage that money, you can make maybe 5 to 10 times kind of return. That's what we are projecting to the foreign investors.
So, and I think that has been the consensus of individuals that I have met today, and also that I consistently speak to. They are very clearly buy on dips, and they are confident in the Indian growth story. You may not be confident about where yields are heading in the US. You may not be confident about where global markets are going, but they're confident in the Indian equity markets. Okay, but then let me talk about Ajay Bagga's portfolio. And
that's what we're talking about. So I'm more of an advisor.
Okay, but give me texture then. Give me say where are you finding opportunities? Are you yourself keeping powder dry? Is that you're fully deployed?
I am always for last 30 years I'm always invested, and the more it goes down, I look around and scrounge around, or even take a loan and put. The India story you have to bet on, And Alex, what will happen? By 2030, you'll be $6.5 to $7 trillion. That's a given. We might hit it by 2028, might hit by 2030, give or take 2 years. But I have really seen, and my generation, I started working in 1990. We are a very fortunate generation. I actually saw my first year income go up 1,000 times, 1,000 times.
Wow.
I've seen this market go up 100 times. If you see a Sensex, and we hit 10,000 sometime in the middle of the 2000s, and it's gone up 6 times. But we have seen 100 Sensex, 100 times. So 79, 100 Sensex, or say 84, it was created at 400, 500. That went to 10,000. I've had stocks, I've seen the IPOs of these companies, stood in line to put in money into the banks, the private banks, or the IT companies, actually made 2,000, 3,000 times returns. So we were a very fortunate generation. So we don't get afraid, because we are not a 97 or a 2000 or 2020 COVID kind of a generation.
Is it easier or harder to make a mistake with what you have, right? With more information, with the ease of access, with
Yes.
a deal that you strike on your mobile phone,
Yeah.
you see a stock moving and you place it. Is it easier to make a mistake and lose money now?
Every day that is happening. See the SEBI report, the 95, 99%, I don't know what traders are losing, because the access has become so easy.
Yeah.
And the options got open to everybody. We never thought that you would have these discount brokerages making 2,000 crore profits, and it used to be a very difficult business. And every downturn, the brokers would get wiped out because clients would not make good the losses. Now you have these armies. So the gamification that has happened, it's become a video game to trade, to invest. So because of access, because of the broadband, because of just the ability, people feel very charged. They don't come to advisors, or they don't leave as much with the mutual funds. You get that kicker by trading,
Dopamine.
which is not good.
So, but having said that, in your experience, because you've seen both ends of that paradigm, is it better to have less information in certain situations and less access and less ease of doing a trade? On balance,
On balance, I would not take away access, because asymmetry of information was different in our time. Whoever could get access to companies would know easier. We have seen the non-demat, all kinds of things. NRIs would leave their stocks with their CS, and it was a racket for the CS to sign false transfer deeds and sell it in the market, knowing fully well it will be bounced for lack of signatures and come back to them when the clients come back. And that would rotate. So we have seen all kinds of scams. I think this is better. You have
is
to
always
progress.
better.
And the electronic digitalization, what has happened is better. I think education, which is very difficult, which is behavior changing, human behavior changing, very difficult, but more needs to be spent. And the brokers and the intermediaries who are making these thousands of crores should also spend on education, I think.
By the way, I'm very glad that Ajay said that, because we are providing you information, and hopefully you're benefiting from that information and staying connected on the go. But just to close out this conversation and to give our viewers the kind of advice that you would give right now, we're sitting in October, or rather the end of October, and heading into a Fed decision just in a few hours. What advice would you give to people if you've made considerable profits? Is it important to take that off the table to rebalance if you have the opportunity to do so now?
It's like, if you come to a doctor and say, what is the medicine selling the most? Should I take it or not? You can't give a straight answer, which one size fits all.
Sure.
I would say, what keeps you awake at night?
Yeah.
I met somebody, I was at a social function, and a lady came up to me and she says, my stocks have gone down. When they come up, should I sell? And I said, what's your asset allocation? What keeps you awake at night?
Yeah.
Because that is your risk appetite. If it's giving you a lot of trouble, then please sell now and get into fixed income.
Sure.
And I will tell you a good advisor's name who can do an asset allocation for you. So I would say, go back to what is your financial goal? What is your time horizon? What is your risk appetite? Very difficult to do that. Either you are in FOMO, that, oh, that train is going, and but there's a train every 12 minutes on that station.
Sure.
And they will be in India for the next 20 years. So we don't need to be afraid of that. Or you are saying, I missed it, and now it is too late, the markets have run up and all. Both are wrong. Come back to your own thing. And so an anti-obesity injection, I'm waiting for myself. It won't work for Alex. I am just saying, and my wife says, go and run. No taking that injection, but it's doing wonders for people. I'm waiting when I can get it officially in India. It works for me because I'm lazy and I'm obese. You are very in good shape. It doesn't work for you.
I'm glad that you think that.
Yeah.
But then I've also been encouraged to run. But on that note, Ajay, thank you so much.
Thank you.
Your point well made. And of course, that's the greatest advice that you can possibly get at this juncture. Thank you so much for tuning in. Do stay tuned. Lots more coming up on BQ Prime.